Welcome back. I'm visiting here today with Matt Garibaldi.
Hi.
Welcome to today's show.
Thank you for having me.
So, Matt, for the listeners, can you give some background of how you got to where you are today?
Sure. Yeah, no problem. So, um, I grew up in Houston, Texas. I'm the oldest of four siblings. My dad is a real estate developer and always took a liking to the real estate business. I kind of followed in my dad's footsteps in many ways. My dad went to Notre Dame undergrad and Stanford Business School, and I did something very similar. So I followed in a similar path. So growing up, I was always working for my dad's companies in various capacities and doing summer internships as a construction right-hand man, effectively. So grew up in and around the real estate business. Always knew that I wanted to get into the real estate game from a very early age. Just always found it fascinating, just walking properties with my dad. Um, so
what
like I
brought
said,
you from Houston up to the Bay Area?
yeah. So after graduating undergrad, I worked in Chicago. Actually, it had a kind of an interesting path. I first worked for for an investment bank, Goldman Sachs, in their private wealth management arm in Chicago, which was a cool place to start my career because it was a fast-paced trading desk type of atmosphere where you learn, one, you have to have attention to detail, very, very significant attention to detail, and you have to work very quickly or else you're going to drown. And so I learned to work very fast in my first job. But I kind of realized early on that private wealth wasn't exactly what I wanted to do. Like I said, I grew up in and around the real estate business and wanted to get into that industry. So I did an internal transfer at Goldman and went to go work for the Whitehall Fund, which is a real estate PE private equity fund within the firm that no longer exists, but it was pretty active at the time. This was back in 2007, 2008. Got the job, moved to Dallas, which is where I met my wife, and worked for Whitehall for about 2 years, working in their limited service hotel investment platform. So it's called Archon Hospitality. We owned around 350 limited service hotels. Limited service meaning Courtyard by Marriott, Residence Inn, Fairfield. They don't have a full food and beverage package. So just given the timing of when I joined that role, I rode the wave up and then rode the wave back down. And it was an interesting time to be in a learning capacity right out of undergrad, learn the power of leverage, the importance of understanding risk when you're investing other people's capital. I learned that firsthand in effectively the eye of the storm of the Great Recession.
And what was the time frame on this?
Yeah, so that was 2008, 2009.
Okay.
Was when I was working in this role. And so, like I said, wrote it up, wrote it down, decided it's probably a pretty good time to go to business school, and applied to a few business schools around the country and got into Stanford here locally. And that's what brought me out to the Bay Area. Like I said, when I was in Dallas at the time, met my wife. She moved out here with me, and we were fully anticipating moving back to Texas. And, the weather got a hold of us and the active lifestyle and ended up sticking around. So we're now Bay Area locals and really love it out here. We're raising our family here. We love it.
So coming out of grad school,
Yeah.
did you jump into your own business right off the bat? Did you continue on working for somebody else or what?
Yeah. So I took my first role out of business school at a local investment firm. It was called American Infrastructure Funds. The idea allowed me to scratch my real estate itch a little bit, and we invested in asset-intensive businesses, of which real estate qualifies. So we started a few real estate companies, and how I met my current business partner, Matt Follett, who's the founder of FollettUSA, is through that capacity. So at American Infrastructure Funds, we started a business together called Inspire Communities, which is a manufactured home community investment platform. And Matt was the CEO of that business. And so we built that into a portfolio of about 36 assets and sold it to Apollo Global Management, which is a private equity firm based out of New York. And that was in Halloween of 2017. Shortly before that, Matt Follett and I decided we became good friends through the process, and him and I decided to start a business together. And so I joined forces with Matt 2.5 years ago. And about 2 years ago, we started Storage Star, which is our current self-storage investment platform. So we currently own and manage 23 self-storage facilities with 2 under development, and we're always looking to buy more. So our hope is to get up to a portfolio of 50, 75, 100 assets. We'll see where it goes, but that's our goal right now. Yeah.
I'm visiting here today with Matt Garibaldi, and Matt, I need to take a quick break, but after we get back, I want to talk about how the self-storage market is doing in today's industry.
Sounds good.
We'll be right back after these messages.
Grandpa, can we do chemistry? Papa, Daddy. Grandpa, let's do something fun.
We'll help you stay organized so you can focus on what really matters in life. Give us a call today and see how we can help you start saving taxes. Welcome back. I'm visiting here today with Matt Garibaldi. And Matt, in the first segment, we talked about your entry into the market into a storage star, which right now you're serving as president.
Correct.
And
that's
founder.
right. Yeah.
And if I understood, it was 23 markets or 23 units that you're
Correct. Yeah, we have
currently
23 facilities that are
Facilities.
operating, and then we have 2 that are under development right now. And we're predominantly located on the Western United States and in Texas.
Do you have a concentration of any of the units into the Bay Area, or they're just spread?
Yeah, so just north of the Bay Area we own. So we own Manteca, Salida, and Modesto. So those are 3 facilities.
Okay.
Woodland, California, Vacaville, Fairfield, Sacramento, Yuba City, Rancho Cordova. So we're a bit north of the Bay. It's very rare to see a self-storage facility come up for sale in the Bay Area because they are such good businesses. Folks like to hold them forever.
Yeah.
And so we would love to own more in the Bay Area. So, but we're always looking.
So I want to delve into the process of how you evaluate. Do I buy the business? Do I not buy the business?
Sure. No problem. So the first thing we look for are there enough people to support the business within the local trade area? And the trade area is generally defined as either a 3 or 5 mile radius from the facility. Call it a 10 to 15 minute drive from the facility. It differs. In some areas, trade areas are a little larger. We own a facility in Cheyenne, Wyoming, and we have a larger dry area. But we look to see, is there a population base that can support this facility, and specifically a facility of this size? And then once you see that there's a population base that can support it, you make an assessment. Is there too much storage in this market, or new supply coming online? The big topic of the day in the industry is there's just a lot of building of self-storage taking place today. It's the secret in some ways is out that self-storage is a great asset class because you have hundreds of tenants. So you have a diversified tenant base. It's a relatively low rental dollar amount. And so it's where if someone might be paying $1,500 or $2,000 a month in rent for their apartment or house, their storage unit's usually like $100, $150, $200. So it's a smaller dollar amount. People are storing personal affects, and so they have an emotional connection oftentimes to what's in their storage unit. And so, it's for that reason, among others, it's a relatively stable business. So we're looking for growing markets, large population, and not too much supply. Like I said, the topic of the day today is there's a lot of building going on. So we're looking for locations where it's hard to build new supply. And so those markets I named in the Northern California area that we own facilities, generally high barriers to entry. And we like that.
There's the old adage that you buy low, sell high, and I imagine that the storage facility is no different.
Absolutely.
When you're valuing going into a unit, though, is there something that you use in the back of the envelope of how do you know it's at the right price?
Yeah. So for anything, the market's gotten more competitive nowadays, right? Interest rates are really low. That's driven cap rates down by historical standards.
What is a typical cap rate for storage?
Yeah, so a typical cap rate, well, in Northern California, 5% is five, 5.5, something like that is very normal within the general Bay Area, Sacramento area. In Texas, it's probably 100 basis points higher, so call it 6%, 6.5%. That's a general rule of thumb. sometimes we'll pay a lower cap rate than that. Sometimes we'll pay a higher cap rate based on what the rents are relative to the market. So, we've purchased facilities in the recent past where the rents are verifiably 15, 20% below market. We'd be willing to pay a lower cap rate because we know over the next 6 to 12 months, we can slowly bring rents up to market, which will then result in a higher yield on our investment than the going in cap rate. And so we're willing to take that risk when we see a good opportunity.
I'm visiting here today with Matt Garibaldi. He is the president and founder of Star Storage. And Matt, I need to take another break.
No problem.
And when we get back, I like to talk about key factors to acquiring a property in the right location.
Sounds like a plan.
We'll
Great.
be right back after these messages.
Thank you.
Grandpa, we found a golden stone.
We have to watch out for the treasure guardian.
Oh no, the treasure guardians!
Since you can't take your wealth with you, spend time with your family. Groco, servicing family office needs
Okay, here we go. Now watch this.
since 1964.
Welcome back. I'm visiting here today with Matt Garibaldi. He's the president and CEO of Star Storage. And Matt, in the prior segment, we talked about the state of the industry, getting into storage units. But you've done this 23 times. I want to pick your brain a little bit in your process of how you decide what you go through to acquire the next property. Do you typically buy existing facilities, or do you develop things from the ground up? What is your process there?
Sure. So we run the gamut of, there's effectively 3 buckets. There's development, there's what's called a C of O or a lease-up deal, a certificate of occupancy or lease-up deal. And then there's also stabilized properties. And we'll buy all 3. Some folks won't touch the first 2. We're not afraid of we look for good long-term real estate investments. And really the simple rule of thumb is, am I fairly confident that in 10 years that piece of real estate is going to be worth more than it is today? We're long-term holders. We're not beholden to a private equity fund, which I think benefits us, because I'm of the mindset that alpha or excess return can be created through time, because there's a number of pools of capital in the market today where time dictates their process, and we try to be above that. So we have all 3 of those types of investment class or subclasses, I guess, of self-storage in our portfolio. So we're building 2 facilities today, one in Lincoln, California, and another in Napa. Very high barrier to entry markets. We like our basis on our land is low, so we're very price per foot focused on the finished product cost. And then on the C of O lease up facility strategy, we own a handful in Texas. There's a reason for that. Texas is a very fast growing market. Cost of living is reasonable compared to California. Great jobs, opportunities for folks who move there. It's a good place to raise a family, good schools, checks a lot of boxes. Texas is also a market that seems to, because of its zoning, catch the cycle early. And so there has been a ton of development in this cycle in Texas, particularly 4, 5, 6 years ago. And that's all coming to market at the same time. And that's resulted in is a lot of new supply. Rates have fallen pretty low compared to historical. And it allows someone like us with a long-term time horizon to come in and pay a fair value or below fair value for an asset and hold it for a long period of time to capture that upside. And so we've pursued that in earnest in Texas, and we think that's a good market for this sort of strategy. And then, the stabilized assets, they're coupon clippers, and we love that. Our investors like cash flow, and we spend a lot of time looking for these sorts of facilities. Unfortunately, they're just not that available. People don't like to sell good assets that are kicking off substantial cash flow. So you don't find as many of those today, but when we do find the one that we like, that checks the boxes I talked about earlier. There's a strong population base, strong population growth, and it's a market where I can see in 10 years that's going to be substantially more valuable today then than it is today, we'll jump in and run pretty aggressively at facilities. So as an example, we just bought a facility in Fairfield and another in Vacaville, markets that we like very much. We see the growth there, and I have a fairly confident feeling that in 10 years, those assets will be worth a lot more than they are today.
The need for an on-site manager, is there a certain amount of scale that's needed before you can justify a full-time employee on site?
Oh yeah, definitely. I mean,
Well, walk me through, at what point in time do you have them live there 24/7 versus show up for a day job?
Yeah, so there was a trend in the industry 20 years ago where when you'd build a self-storage facility, you'd build an apartment on site. Much of the management in the industry has moved towards REIT, professional manager. So CubeSmart, Extra Space, Public Storage, they all manage third-party facilities. They don't really love having a manager live on site. There's a host of liability reasons for that. We own a mixed bag of facilities that have on-site apartments. We offer them up to our managers. Sometimes they want to use it, sometimes not. We view that as a perk and not as a method of compensation, if you will. We still pay people a fair wage. Some people view them as the on-site apartment is a type of compensation. We view it as a perk. There's a big movement in the industry of moving towards kiosk, which are unmanned facilities. We think that there's a great place for that in the industry, particularly for smaller facilities called 30,000 net rentable square feet or smaller. Our portfolio consists mainly of larger facilities, and we're a high service company. We believe that storage in many respects is a commodity. It's space that people are renting. However, service can make a difference between your space and someone else's space. So we're a high service, high touch company relative to the rest of the industry. And because of that, we hope we command a premium price. And so for that reason, we have all of our facilities with on-site manned individuals.
When you're when a consumer is looking for a storage facility, in your opinion, what do you feel some of the things are that they should be looking for?
Clean, safe, and secure. That's really the simple answer. Is the facility well maintained? Because if it is, and it's clean, that's usually an indication of the quality of the management and the attentiveness of the management. Safety, obviously, you don't want somebody breaking into storage facilities, and you want to indicate safety. You want to look, are there cameras on nearly every corner of the facility? When you walk into the office, do you see TV screens with a live feed of the camera? That means someone's constantly watching it, right? And then safety and security just should be a table stakes. It should be a given. But you'd be surprised. A lot of folks just take their eye off the ball, and break-ins are fairly common in certain parts of the country. We try to mitigate that through having a robust security presence and robust on-site cameras.
You take investors in?
Yes, we do take investors. We do. We syndicate our investments. We invest our own money alongside each one of them. We invest solely on behalf of high net worth individuals and family foundations, non-institutional investors. Really is the way we think about it, because folks who, one, can take the tax benefits of owning real estate, we view that very attractively, and also don't have the time horizon of a fund. We view that as a competitive advantage of ours as well. And so mostly high net worth individuals.
So Matt, if someone wants more information on Storage Star, how would they contact you?
Sure, absolutely. So they can send me an email, mgaribaldi at FollettUSA.com or matt@storagestar.com. I have 2 email addresses. They can also go to our website, and there's a contact us link there. They can reach out to us anytime. And yeah, we're always looking for new folks to meet, and new investors, and anyone looking for to rent a storage unit. So reach out anytime.
Very good. I've been visiting here today with Matt Garibaldi, and I appreciate you being on today's show.
Yeah, thanks for having me.
We'll be right back after these messages.